Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
Right, the headline is political theater. The market issue is deterrence. If the alliance becomes less operationally credible, investors reprice risk across sovereign debt, energy, defense, and growth expectations.
So the real question isn't, did somebody say something spicy at a podium? It's, would Europe be harder to defend next quarter, next year, over 5 years?
Exactly. And the answer depends less on speeches and more on Europe's fiscal and military constraints. If the US provides less, can Europe replace it without blowing out deficits and widening bond spreads? That's the premium markets will care about.
Let's define terms, because this gets muddy fast. Formal withdrawal is one thing. Hollowing out is another.
Formal withdrawal is legal and political. Hollowing out is operational. The alliance can still exist on paper while the US reduces the enabling capabilities that make it effective.
And those enablers are not decorative. ISR, AWACS, aerial refueling, strategic airlift, missile defense, signals intelligence, that's the plumbing.
More than plumbing, it's the nervous system. Europe has forces, yes, but replacing those US functions quickly would be difficult. So NATO could remain nominally intact and yet become strategically less credible. Markets tend to notice credibility gaps before politicians admit them.
There are roughly 84,000 US service members in Europe. People hear that and make it a body count debate.
Which is shallow analysis. Troop count alone misses the point. Those forces sit inside a larger architecture: forward basing, logistics, command and control, pre-positioning, and rapid reinforcement.
Basically, it's not just the number of firefighters, it's the trucks, hydrants, maps, radios, roads, and the guy who knows where the water pressure is. Terrible analogy, but close enough.
For once, yes, deterrence works because an adversary sees an integrated warfighting system, not isolated battalions. Degrade that architecture, and you weaken response time, coordination, and escalation control. Markets don't model that elegantly, but they do assign a higher risk premium when the security umbrella looks thinner.
Now, the ugly arithmetic. If Europe had to substitute for a meaningful US reduction, you're talking about a replacement burden measured not just in money, but in troops, equipment, readiness, and sustainment.
Correct. Tanks, infantry fighting vehicles, air defense, munitions, spare parts, maintenance pipelines, transport, training cycles. Budgets make it look easy because budgets are accounting entries. Military capacity is industrial reality.
And industrial reality has lead times. You can't yell urgent at a procurement office and have armored brigades appear by Friday.
Nor can you ignore interoperability friction. Europe is not one military. It is many national systems, doctrines, procurement processes, and inventories. That fragmentation raises cost and slows scaling. So even aggressive spending plans may translate into usable capability only gradually.
That brings us to the financing side. Rearmament sounds decisive until it meets sovereign balance sheets.
Yes, elevated debt ratios matter. France has less fiscal room than the political class likes to pretend. Germany, relatively speaking, has more room to maneuver, though even there the constraints are political as much as financial.
So if defense spending rises sharply, deficits widen, flexibility shrinks, and the whole thing stops being a security story and starts being a bond market story.
That's right. Higher defense outlays can pressure sovereign spreads, especially where growth is weak and refinancing needs are substantial. Governments can promise rearmament. Bond markets ask what it does to debt service and fiscal credibility.
Dad trusts bond markets more than central bankers, which honestly is one of the family's more cheerful traditions.
Because bond markets are less sentimental. Spreads transmit fiscal stress into real financial conditions. If investors worry that debt heavy rearmament weakens a sovereign's trajectory, funding costs rise before ministers finish their press conference.
And then duration risk matters, refinancing calendars matter, rating sensitivity matters. Suddenly, defense policy is sitting in the same chair as credit risk.
Exactly. For France and Italy, especially, markets may punish ambition that lacks credible financing. Germany is different, but Germany alone cannot underwrite the entire continent's strategic shortfall without consequences elsewhere.
Now, layer on energy. If the geopolitical backdrop includes Iran and risk around the Strait of Hormuz, markets get another problem immediately.
A very immediate one, a choke point carrying roughly 20% of global petroleum supply can dominate near term volatility. That's not theoretical. Even a higher risk premium in crude can tighten financial conditions.
And Europe, which already knows what an energy shock feels like, doesn't need a refresher course.
No, crude spikes feed into inflation expectations, shipping costs, and growth pressure. So now you have defense spending needs, possible sovereign stress, and an energy overlay that can complicate monetary policy and weaken real activity at the same time.
On the equity side, the obvious trade is defense. When governments rearm, defense names can outperform.
Yes, and examples often cited include BAE Systems and Rheinmetall. The market sees order visibility, political support, and a multi-year demand tailwind.
But there's a catch. A fat order book is not the same thing as instant production. Factories still need tooling, workers, components, and time.
Precisely. Capacity limits matter, skilled labor shortages, supply chain bottlenecks, and production constraints can cap near-term delivery. So the equities may discount growth faster than the industrial base can physically supply it.
And this doesn't stay neatly inside the defense bucket. The spillovers spread into energy, industrials, banks, and sovereign credit.
Because fiscal choices are zero sum at the margin. Higher military spending can crowd out other priorities or force more borrowing. That changes sector leadership, valuation dispersion, and credit perceptions.
Banks care because they hold sovereign debt and finance the real economy. Industrials care because capex shifts. Energy cares because geopolitics. Everybody gets invited to this party, and nobody really wants to be there.
That's about right. Investors should expect broader market rotation, not just a simple buy defense response.
So, what do you monitor if you want signal over noise?
First, NATO capability gaps and any change in US posture, especially enablers. Second, procurement timelines, because announcements are easy and delivered capability is hard. Third, euro area deficits, with close attention to French and Italian spreads and Germany's fiscal response capacity.
And on the market side, crude, inflation break evens, and defense sector order books. If oil is rising, break evens are moving, and order books are swelling while spreads widen, you're seeing the second order story form in real time.
Yes, watch what tightens financing conditions. That will tell you more than summit communiques.
So the bottom line is pretty simple, even if the machinery underneath it isn't. The market story is operational deterrence plus fiscal stress, not slogans.
Correct. Europe's debt constraints make rearmament slower, costlier, and politically more fragile than many assume. If US support is reduced in function, even without formal withdrawal, investors will likely focus on spreads, energy risk, and defense capex transmission.
Which means don't get hypnotized by the headline tape. Watch the plumbing, the bond market, and the fuel bill. That's usually where reality sneaks in and whacks you with a ruler. Childhood memory there.
A deserved one, usually.
Fair enough. Thanks for listening, everybody. Bob, good to do this with you.
Likewise, Josh. We'll continue next time. Goodbye.
See you next episode.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start a conversation with a member of our team, Robert, Joshua, Andrea, Mike, or Eugene, and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.